Okay, so really excited today. I am live with Tim Schigel, who's a managing partner at Refinery Ventures. They invest in tech companies with demonstrated product market fit, and he's also launched and managed Cintrifuse, which is one of the best performing fund of funds in the country, investing in, they've invested in the 15 top tier early stage funds across the US. Tim grew up in Cleveland as the son of a steel worker and a Vietnam veteran. He received his BS in electrical engineering, just like me, from Case Western Reserve University, and he's a member of YPO and a global network of chief executives. So YPO is a great organization. But Tim, excited to have you on the show. It's been great community building with you. You've been to my dinner. I've been to your dinners. So glad to get you on the pod and learn more about Tim.
Awesome, Joel. Thanks for having me.
So why don't we kick this off? Tell me a little more about who Tim is. I know that you were the son of a steel worker, but tell me a little more that was going on in your mind when you were a child and, throughout your formative years, and then starting your career. What did you think you would do? And how do you think that's kind of pivoted as of now?
Yeah, no, that's good. I love it. When I'm asked to sometimes speak at, some colleges or whatnot, and they want to know, explain your career path. I'm like, are you kidding me? How do you do that?
What's a path?
That's probably true for most people that get into venture. So I have a large family. So I had 36 cousins on my mom's side, mostly blue collar or entrepreneurs, a couple uncles that had their own businesses. I was one of the few that went to college. I was either going to go to Case Western, Carnegie Mellon, or Stanford. We didn't have much. Case was there locally. It's a great school. Mm-hmm. My dad was actually an electrician, never went to college, but was very good. So he could build and fix TVs and radios and you name it. So I was always around technology, and I played guitar. Mm-hmm. So I was always into all the music gadgets and amplifiers and processors and all that stuff. But basically all I knew, because you don't know anything when you're a high school kid, right? And I could have gone into anything. Mm-hmm. I just knew that the future was going to be heavily based on technology.
Yep.
Right? And electrical engineering is a great platform, a great foundation that you can really do anything.
What was your favorite class in engineering? Like when you were in college, what was the favorite course that you took?
Well, my favorite one that just beats your butt, and that's probably why it's my favorite. I never took classes because I could ace them. I took classes because I was going to learn something.
Sure.
So I didn't always have the greatest grades, but satellites and antenna radio wave propagation or something like that.
Sure.
By a guy who built the satellite array at MIT. He wrote the book. It was all Maxwell's equations and all this stuff, and it was just you're dealing with math that includes no numbers. Mm-hmm. So it was just fascinating. It's like operating in a fourth dimension or something like that. Not that I apply any of it directly anyway, but I do think it helped a lot. And then my job in school, one of my jobs was I was a bartender at a big Italian restaurant and bar, and one of the professors would come there often, Dr. Katibi.
Sure.
And he took me under his wing and was my advisor for my senior project. So for my senior project, I actually created a digital signal processor for music. Okay. So I built the hardware, built the software in ThinkC on a Mac, built the whole thing. That was my favorite class because I brought it all together into something.
Yeah.
That guy, Dr. Farouk Katibi, went on to Qualcomm, where he was basically the kind of founder of CDMA and cell phone networks as we know it today.
Sure.
Pretty darn cool. So, but I also blended. I was one of the first students in a curriculum between the Cleveland Institute of Music engineering school. So I was doing and learned how to do digital music production in the 80s, which was also very fun. But I was the only one that was an engineering student, wasn't a music student. I had to go across campus, and the only way to get lab time at the studio was to get to the studio at 4 a.m.
Yeah.
It's studio at 4 a.m, and then I could have all the toys at my disposal. Mm-hmm. And that's what led to my first job. But like I said, I think engineering, STEM, degrees. I always tell young folks, students, my kids, just get a good degree, first of all. Don't worry about what you're going to do. I didn't know what I was going to do, right? I had no idea. Don't put that much pressure on yourself.
Yeah.
You'll figure it out later. My kids all got to go through co-op programs every other semester. They work. That's a great way to figure out what you don't want to do, right? Because you're only committed for 3 months, and you figure it out. Luckily for me, I was interviewing with all these big companies, the IBMs and GMs and all these big companies, but it was a small company in Cincinnati that reached out to me because of the music connection. And the co-founder of this small fund went to Stanford, and a lot of his friends were at Apple, and he's a musician, so he really liked the fact that I did this stuff with Apple, with Macs, and was doing recording. And I worked with him and his brother, Mark and Rick, only to find out later, several months later, that it was Neil Armstrong's sons.
Wow.
And then, so I got to know Neil and got to work with Neil, and my kids got to grow up knowing Neil, which was unbelievable.
That's pretty amazing.
But through that company, that started my Silicon Valley connection. So we were one of 2 software development firms that did custom, basically enterprise level software development for Apple's biggest corporate customers.
Sure.
And one of the biggest ones was here in Cincinnati, Procter & Gamble. So I literally helped build Procter & Gamble's computer network and put in their first email and all those sorts of things. So it's amazing where it led, all from just having that electrical engineering base. Sure.
And then tell me what happened after that. So tell me a little more about your time in Silicon Valley. Yeah.
So I was doing a lot of work for Apple. I basically became a.
Did you meet Steve Jobs?
I never met Steve Jobs. Met Wozniak. Met Gershon Sadhu, the founder of Apple Talk. Folks like that. John Scully. We did one of the first applications, kind of a use case for the Newton. If you remember the Newton.
I remember the Newton. Yeah.
Those who don't know, the Newton was the first personal digital PDA handheld device, kind of precursor to phones.
Did that have the pen, the stylus, or was that Palm?
Palm had one too. So did the Newton. Newton had a flip top cover. It was bigger, and so Apple asked us to build an application for Monsanto. Okay. We wanted to show precision farming and how they could scout fields in the field with this handheld device. And we demoed it at the Newton launch with John Scully, which was really cool. So we did a lot of fascinating projects because Apple at the time was not big into enterprise, right? So anyway, I worked with somebody at the time when I was at that small company that basically taught me about customer-driven product design. Sure. Kind of as it was developed from Japan and then carried over here to places like Procter & Gamble. So things, house of quality, if you've heard that term, house of quality, QFD, which is quality function deployment. There are all these techniques for drawing out what customers really need and want. Sure. And applying it to strategy and products. So I kind of became a guru on that, and that ended up, I did some independent consulting through a couple other firms, and did work for Hitachi and their high-speed laser printers in Japan, did work for Samsung and Daewoo in Korea. So I was traveling all the time. And ultimately, and particularly because of the Apple work, and I had an office at Apple, but we were having kids relatively early. So kids at 25 have three kids. So was setting down roots here in Cincinnati. So I was happy to travel, but we never had to move. Some people think I lived out in Silicon Valley. I've had a rental house there for a number of years, but never lived there permanently. But very kind of at home there, as well as in New York. But I really wanted to get into venture capital, and just thought, just was into, ideas, right? Ideas, technology. And I thought, well, the best way to get into venture capital, either go to like Harvard Business School. I felt like I was a little too late for that. Had kids, was making good money, didn't didn't feel like that was route, or be a founder of a company and develop a relationship with venture firms and end up there one day. And so I did. I started up an internet company in the 90s that ended up failing, but it got me noticed by a venture firm who asked me to join them.
Sure.
So I joined a firm in 98. We had 4 funds, 600 million under management. And literally the first deal I worked on.
It's a large fund. I mean, today, right? But I mean, in 96.
So the fourth fund was 230. So the total was.
Total,
Even today, it was Cincinnati based.
Yeah. I mean, even today, 200 is a lot. I mean, for venture, right? Hedge funds, an emerging manager for a hedge fund is 400 million, right? So.
Yeah. No, it definitely was. The founder of that firm did a great job, got all the big, like a number of big pension funds in. That's kind of what did it. Had some good success with the first fund. I came in at the tail end of the second fund. And literally the first night at work, I was still in the office. It's like 7:30 at night. And he asked me to do a phone call with one of the CEOs that they previously backed, who came from like telecom and media industries. And he pitched me on this idea. And this is my first day as a junior venture capitalist.
Sure.
And he described this idea of taking enterprise software and instead of buying it and buying the software and installing it on computers and servers at your company, he would host it at a data center and you could rent the software.
Wow.
It's like, what?
Mm-hmm.
And I wrote down, ESP, Enterprise Service Provider. Well, that became known as ASP, Application Service Provider. And the company was called US Internetworking, and it was really the first one that what led to today, the cloud.
Mm-hmm.
And that company, we basically did and this is crazy to think about. So this is 98. We did a seed round. It was our firm, Blue Chip, it was called, Growtech and Venrock, Ray Rothrock from Venrock. We did a $33 million seed round in 98.
Wow.
Now, part of that's because everybody knew this guy, the operator, the CEO and founder, Chris Perry. The second round came less than a year later of 62 million. So it was like one of the largest funded tech companies that went public. It was worth 3 to 4 billion.
Sure.
And we were limited at how much we could sell, but we did sell enough to still have a great return.
Mm-hmm.
And the company was kind of a high flyer for a moment until the .com came and everything changed, right? Mm-hmm. So it was a heck of a first experience getting into venture capital. And the interesting thing is that Ray Rothrock from Venrock, who I met, like I said, in my first deal, is now a co-investor with us in a deal in Silicon Valley. He's retired from Venrock. And so we're working together again, whatever it is, 20 some years later.
Sure.
So so then I was in that firm for 10 years. The company that, and I believe, by the way, I believe in venture capital. It takes 10 years to learn venture capital, and you need to kind of go through that economic cycle like I did for the .com bubble and bust. But I led an investment in what became our most successful company just from an operating metric standpoint, which was advertising.com. Mm-hmm. And advertising.com was acquired by AOL in 2004.
Sure.
And they went from 0 to like 135 million in 5 years, something like that. So it was a big success. We became known because of that and a number of other deals like Nielsen Buzzmetrics and AppPlan and Tom Burgess, one of the first mobile advertising companies in Boston, Third Screen Media. We kind of had really good deal flow in the ad tech space. And I felt like there was something new that was emerging that was going to, be kind of a new era in how we navigate information. And I had this theory of creating, I'm a big complexity theory fan. Mm-hmm. So Santa Fe Institute and all that kind of stuff, right? I used to read all those books and meet some of those people. And so I had this this concept that cold called a guy, Dr. David Goldberg, who was a professor at University of Illinois, and he's kind of considered the father of genetic algorithms, which is one of the early machine learning techniques.
Sure.
Now, it was Dr. John Holland was really the founder of it. David Goldberg was his PhD student at Michigan. So John Holland's the one who imagined it. Dave Goldberg put it into practice.
Sure.
And I didn't know this guy, but I reached out to him, and I had this thesis for building what I call the consumer chromosome, which is like the ultimate cookie, the ultimate way to understand people's preferences online. And we incubated this company and did some research and discovered that most people did not find information from Google search. Everybody thinks they find information that they know they're looking for in Google search.
Sure.
But information that they weren't expecting to find, they get from links people share with them. And that became very clear. So I created something called Share This. So I get a little card here. So whenever you share something on the internet, I don't know if I got the right direction. You see that little symbol, I created that.
Oh, nice. Okay.
And it became the standard. It is the standard. I mean, there's jobs
for sharing. It's a share icon. It's the I guess it's a string of code that enables the sharing capability, right?
It enables the sharing. It also enables the tracking that the publisher can use for advertising. And so it was one of the first early companies in social media marketing and advertising. So I left the venture firm, became CEO, ultimately set up headquarters in Palo Alto. Draper Fisher led a Series A. I went from 0 to 50 million in revenue in less than 4 years.
Wow.
And it was fast. So we had an office in Palo Alto, LA, Chicago, New York, now London. So it was an amazing experience. Ultimately, the investors wanted the CEO to live on the West Coast. I didn't want to move my family at the time. The kids were like high school. And so I became chairman and wasn't involved in day-to-day. And soon after that happened, in Cincinnati, the CEO of Procter & Gamble and the other CEOs of the big companies here said, we want more venture activity in Cincinnati. And they asked me to help start something called Cintrifuse.
Yep.
Intrifuse, and create a fund of funds. And I'm like,
why? And let me ask you this. So why did they prefer to have a fund to fund structure versus just investing directly into portfolio companies? And when I think about it, I think it's very strategic, because if you're at the top of the food chain and you're the fund to fund, you attract all the other funds too, right? Because they're trying to raise. But I feel like the capital will follow. But that's my thought. Again, I'm not trying to complete your sentence here, but just curious.
No, that makes sense. It wasn't necessarily a no-brainer, because it is counterintuitive. They actually borrowed from a model called Renaissance Fund in Michigan. I know them. They're a pretty big fund to fund as well. Yep. It's Chris Ryzik, and I knew Chris. I called him up, and
not Renaissance Technologies. That's Jim Simons, right? Yeah.
They're the whole state of Michigan. Cintrifuse was just the Cincinnati region, so there's a little difference there.
So they were trying to learn from. So what did they learn from their playbook?
That they basically were able to attract other venture firms from around the country to Michigan.
Yep.
And it's being able to leverage the venture experience of other managers, other GPs, right? And not expect that all the best investors are going to be in Cincinnati, right? So that's the good news. You build this great network. And I did that for 4 years. For a good 3 years of it, I bet we had averaged, I think, 2 or 3 venture firms per week visiting Cincinnati. Right, because it was one, a fund to fund, so they're fundraising, of course, but 2, it was from strategic investors like Procter & Gamble and others. And so it was a great, I call honeypot, if you will, to get people here. And we invested in Techstars, and part of that deal was that they would host a founder con here, which was a huge success. And so Cincinnati was really rocking, and other cities all wanted to know how we did it. The downside, the negative to it, as I said, is kind of counterintuitive. There's no guarantee that those funds are going to invest here.
Mm-hmm.
We wanted to invest in regional venture funds. There's just not a whole lot of them. And when I was being hired, they specifically wanted somebody who was, as they said, had a strong backbone because they knew that the requirements had to first be performance and second regional engagement.
Sure.
Because attempts by other economic development groups flip that, right? If you make a token investment in the region, then they'll invest in your fund. It doesn't mean you're a good fund.
Sure.
So they said, we're going to reverse that, which I liked. We had 120 million under management. We did not have any state money for the fund. So we were free to do whatever we thought was best. And we would do follow on later.
So it's just from Cincinnati. It wasn't from Ohio, is what you're saying, right?
Just Cincinnati, right.
Got it.
Most corporate.
Mm-hmm.
We could do some directs. We only did a handful of directs for local companies, usually if we were adding on to a larger, $10 million round or so, right?
Sure.
But we did not want to. One of the other key guiding principles was we were not competing with the local venture ecosystem.
Yeah.
We were trying to be additive, helpful.
Absolutely.
So I would do portfolio reviews with all the local firms every quarter and say, okay, what do we got? Who are the best companies? Who can we show off to coastal investors, et cetera, et cetera. And so there's definitely things from that worked really well. There's also some things I would tweak. And the group that runs it now, JB Kropp is currently the CEO. He actually worked for me at Share This. He's allocating more to local, including to Refinery. So he's changing the mix and trying to learn and adapt, which is good, smart thing to do. But through that time, what I learned, I wasn't sure. People would ask me, "What are you going to do? What do you want to do next?" When I took that job, I did not want to do it forever. It's sort of quasi economic development. I wanted to help out. I'm more of an operator. I always say I identify as a tech entrepreneur at the end of the day, regardless of what hat I'm wearing. Sure. And
I mean, look, launching a fund is a business, right? You got a website, you've got 5 different types of customers, right? So, it's the entrepreneurship of capital creation, right? And capital deployment. But I hear you. Yeah. I mean, look, I work for we talked about this in dinner. I worked for the DOD for 4 years, so I get my hand, you get your wrist slapped, and you have to kind of follow a certain protocol and like a process, which, serial entrepreneur may sometimes have problems with.
Yeah, exactly. And people would say, well, do you want to do a venture? You want to go on venture again, or do you want to do a startup? And my honest answer was, I don't know.
Yeah.
And, career tip. I felt guilty saying I don't know for a while. Then I embraced it and said, no, I'm in a discovery period. I'm in a exploration period. I'm just going to network and help people where I can and see where that goes. Sure. And where that went through that experience with Cintrifuse was my next big aha moment. Like Share This was my first big aha moment when I came up with something that nobody had ever done on the internet, right? Nobody thought to capture shared links before. This was my second big aha moment. Is I met with hundreds of entrepreneurs, throughout the Midwest in this time, and I didn't have a fund. I couldn't invest directly. I could introduce them, but I couldn't invest. They'd come to me and let's say they had $500,000 or $1 million in revenue. Sure. And I'd start asking this one question over and over again, which is, what has to be true to do 10 million next year? And they looked at me like I was asking them to go to Mars. Like you could tell they never thought of the question. Well, though,
here's a unique thought. Everyone's probably heard this before, but Elon Musk said, look, if you give yourself 30 days to clean your room, you give it 30 days. You'll do it in 30 days. Right. You give yourself 3 hours to do it, you'll do it in 3 hours, right?
So I know somebody that works directly for Elon. I met Elon years ago, but I know somebody who works in finance for Elon. We talk about this.
Sure.
And what he calls it is right to left thinking, not left to right. Like, get yourself out of the spreadsheet. Don't say, oh, assuming 20% month over month growth. No. What's the number need to be at the end of the year? When does the rocket need to launch? And what do you have to do to make it launch in that window?
Sure.
Period. And so after asking this question 100 different times, I realized that the entrepreneurs aren't asking that question, and neither are their seed stage investors, by the way. And it's not, and so why aren't they asking that question, right? They're smart people. They went to great schools, have good ideas. Why aren't they asking that question? And I reflected on my own experience. And when I was building Share This, I took pages out of the playbook from advertising.com, where I was in all the board meetings. I had all of my notes from all the board meetings. And I looked and I said, well, here's what they did from Q1 to Q2, and here's what they did from Q2 to Q3. And it's just like if you were trying to train for a marathon, right? You go to talk to somebody who's run a marathon and say, how do you train? And what do I need to do? And what kind of pacing do I need? And blah, blah, blah. That's what I did. And that gave me a framework that helped Share This grow as fast as it did. It also takes luck and timing, by the way, right? If you're in a bad market, there's nothing you can do about it. So the timing was right. But what dawned on me was that outside of the big tech hubs like Silicon Valley, the big gap is an experiential gap that entrepreneurs have. They don't have a knowledge gap. They have an experiential gap, which is hypergrowth. They don't know what it looks like. Think about it. Most people in the country work for companies that never have hypergrowth. Right? They may never work in a company that has triple digit, percentage growth year over year. That goes from 1 to 10 or 10 to 100 million or 100 million to a billion. Like, I've got a kind of a thesis: growth is growth, right? And venture requires it, right? Because venture is, unlike private equity, venture is all about growth and becoming a market leader, or being at least perceived as a market leader. That's how you get a big valuation, right? Because you're taking business from the incumbents. You've created a new market opportunity, ride sharing with Uber or, Airbnb or what have you. So it requires that kind of growth, which is basically just an indication that you're opened up a new market. And that's what you need in venture. And that if you're on the West Coast. If you're in the Midwest, you don't necessarily always understand that. You don't have people around you showing you that or telling you how it's done, right? So there's not a lot of talent there. So the aha moment for me is, what if I created a venture fund here in Cincinnati, where I live, where I prefer to live, knowing that I've worked in New York and Silicon Valley, and I understand how those worlds work. And I focus on recruiting leadership talent that has those attributes, that have been through hypergrowth, but maybe they grew up in Ohio and went to Ohio State, or they went to Carnegie Mellon, or they went to University of Michigan, and they go to the coast and they get that experience, and they come back. Usually I get a phone call, and the phone calls are always the same. Hey, I went to University of Michigan. I went out to the West Coast. I worked for, Twitter, blah, blah, blah. I got married last year. And then the next thing is, and I'm about to have a kid, and we're thinking of moving back to the Midwest.
Sure.
Well, I love those people. I mean, I call them the boomerangs. Those people have so much to offer because of what they learned in that experience. Matter of fact, they don't even understand how much they have to offer.
Sure.
Right? They may even take it for granted. But that, to my point, that leadership and growth experience is very rare. So we're creating a program and a fund that's focused on sourcing that talent, and we call that X15.
Okay.
It's a network of hypergrowth leaders. They're not necessarily, by the way, founders, or they haven't been founders. They could be a founder, but they're not yet. And quick quiz: do you know what an X15 is?
I don't.
Your DoD guy?
No, I don't actually. Sounds important.
The X-15 is a rocket jet. It was Lockheed, and Neil Armstrong flew it before the Apollo mission.
Got it. Okay.
So it was his first hypergrowth experience, is what we call it. So that's what we call our network. And we've been building this network of talent.
Mm-hmm.
And we're, nobody's ever done it. And it's really, I don't know, are you familiar with what a search fund is?
Oh, yeah, absolutely.
So search funds usually associate with private equity, right? It's a way for...
I mean, it's what people in Harvard do, right? They graduate from Harvard and they join they start a search fund, or they become a searcher, right? They find a company and then they pretty much give themselves a job, right? They operate the company.
Yeah, they're trying to. They basically it's like a micro PE fund.
Yeah,
to some degree, they're fresh MBAs. They go out and find sponsors who pledge to put up whatever it is, $10 million or $20 million for them to buy a business.
Yep.
They have a thesis like, hey, I want to acquire a printing company, or I want to acquire it's typically conventional businesses, right?
I got a question for you. What would you buy if you were coming out of college? What would be the ideal business that you'd find and get people to pledge for this day and age?
Just if I were to go back in time?
Yeah. Or I mean, right now, it's like, look, you maybe run a little search strategy on the side. What type of business would that look like?
Like car washes or something, right?
I literally am looking at a couple car washes right now. I would look at businesses that are completely automated. So I would buy them, coming in, maybe it's an elderly couple that has just had it for a long time. And I would love to just buy one that is just completely robotic, and then that gives you some value creation that you can add on top of that. But it's crazy how you read my mind.
It's people are spending money on that stuff every day.
Yep. Even during a recession, people got to clean their cars.
Well, you mentioned in the intro, like I'm a member of YPO, and I've been chairman of the local chapter and international. And most of the people in YPO run regular businesses, not necessarily tech businesses, and maybe multi-generation or whatever. And they make a lot of money. A lot of my friends have those kinds of businesses and make a ton of money. So when an entrepreneur comes to me and wants to raise venture, I challenge him a bit, because I'm like, look, if you want to raise money, go buy a car wash, right?
Yeah.
Or go start a commercial landscaping company or something.
I mean, you told me your father was an electrician, right? I mean, there's a whole thought process around people being plumbers and electricians. Those people are like multimillionaires in New York, especially, right? I mean, these services are going to get more and more expensive every year. If you own a car wash, that real estate is going to appreciate. There's depreciation that you can take, and then you can write off all your expenses. You can't do the same with venture. I mean, in that same way. So,
right. Well, no, venture's not. That's back to venture's not the get rich quick model.
Sure.
Venture is really for opening up a new market, redefining a category, and kind of really making a dent in the universe. And if somehow you're able to survive as the founder to continue to be the CEO, which I'm a fan of, but not everybody does, then you can make a lot of money, right? But it's a very small percentage of people that can actually pull that off. So it's an interesting.
No, it's a barbell though for a lot of your YPO people, right? Because they've got those, traditional businesses that generate cash flow, but you're not going to get a 5,000x like you would if you went early stage, right? So that's the strategic outsized returns that I think is really great. I think with a lot of emerging managers, we're going to talk about this because I know you probably supported a lot of managers and had a lot of advice for them. I met one of them right over dinner and got to know her pretty well. But like I would say, as you're educating LPs on like what the benefit is, right? Especially these YPO graduates, why venture, right? Like how are you educating these fund managers to help share the value of early stage venture and even growth equity, right? There's even different vehicles and products that you can offer within venture, but how are you mentoring these managers, and how has that changed since from when you were at Cintrifuse?
Well, first of all, if you're going to be in a venture firm, be a venture firm. Don't try to be something else. So the firm I came out of, the first firm I was part of, their strategy, they called the balanced strategy. So they were like part private equity, part venture. No.
Yeah.
If an allocator from a pension fund or an endowment wants venture, they want venture. If they want private equity, they'll do private equty, right?
Sure.
And private equity is all about getting 2 or 3 times your money by, wringing out operating efficiencies and usually, multiple arbitrage. Venture is very different. Venture is all about power laws, right? There's 1 in 10 that returns everything. And so you have to embrace that and understand it. And for people that have been in private equity, they can be scared of or turned off by the loss rates, right? Venture typically has 20 to 40% loss rate.
Yeah.
And the venture firms, when I was doing the fund of funds that we liked, they didn't shy away from that. If a manager was pitching us and was taking too much time defending the losses, we knew that was a problem. Right? And I learned that in the first venture fund I was part of. We tried to save too many deals. That's a waste of time. You can't always save them. And even if you can, you save it and you get 1 time your money. So what? Whereas the big one, you're gonna get 100 times your money.
Sure.
Right? And so you have to be comfortable with that. And many funds, and especially if it's a manager that hasn't been in venture before, so a new emerging manager or what have you, they may not understand that yet. They may not grok that yet, right? Because you have to do it's a bit of a psychology mental hack, right? When you make an investment in a company, you end up taking personal pride in it, right? You want to defend it, you want to help it, you don't want it to go poorly. And you need others to help you to save yourself. It's like there's only so much you can do, and I'd rather make another bet and try to get another 20 or 100x or 1000x instead of sucking up all my time. So that's a very hard lesson that not everybody gets to learn. So that's a big one. I think the loss rate in venture versus later stage, whether you're an LP or a GP, is something that people need to understand. The other thing is for GPs, for early stage funds, the next important thing, and we would say this because we had an investment committee that included a retired former Cambridge Associates managing director, right, who created benchmarks, basically. If the general partners said the phrase portfolio construction, it was probably going to be a good meeting. Just because they understood that. Too many funds would come to us and they'd have nice logos and you'd say, how much do you own? They have enough ownership for it to, even if it was worth $1 billion, wouldn't return the fund. So on average, you have to have enough ownership in each company that if you had a moderate exit, you could return your fund. If it requires Facebook size exits, you'll never get there. Right?
No, I totally agree.
You might get lightning in a bottle, but probably not. So that's just a math problem, right? And so for engineers like us, we can understand that, but not everybody. It's amazing how many people don't think through that.
What are the biggest questions that managers have asked you in the last maybe 6 months? Are you getting a lot of questions around portfolio construction? What are some of the hot topics that you're hearing right now for managers?
Oh, the biggest hot topic
beyond how do you meet LPs?
Well, the biggest topic is fundraising and liquidity, right? So venture, in the last couple of years, you've had the Magnificent Seven. Wealth managers, other investors just say buy NVIDIA. That's all you have to do. And they're not getting liquidity from venture. Matter of fact, venture and private equity, the most important stat I would say to look at, if you can see it or find it, is distributions as a percent of NAV. So you look at total net asset value of all of venture, and what percentage of that is distributed every year. And historically, it's in the 15 to 20% range. Say.
What's it now?
Last few years, it's been under 5%, and it's been staying there for quite a while.
So I would say that's probably why some of these mega funds are offering so many products, right? I mean, they're like, hey, you know what? I know you're locked up for like 10 years. So we just launched a secondaries fund.
I think, and also, so I get emails from secondaries funds, every day, right? And one of the big questions is that going to be a permanent fixture layer in the capital stack? Because not just because of today's environment, but because companies don't go public anymore, right? And like when I started in this business, you can go public with 30 million in revenue.
Sure.
Look at Canva, and companies like this that have tens of billions of revenue. So is there a more permanent stratification of that capital so that the early stage venture can get out sooner? Yeah, I'm still a believer. Early stage venture, seed and Series A is where all the money's been. That's always been historically the group and the stage that's made the most money, right? The thing is different now is where do you get that liquidity from?
Sure.
I think more funds may have more policies that say, hey, if we get, if we do follow-on rounds in a company, Series B or C, and we're at a 10x or 20x, we have a policy to sell, in each of those rounds or something like that, right? Just to generate more liquidity. I think we're likely to see more of that. So that's a challenge that funds have. But then you have like Andreessen and others becoming RIAs.
Yeah. I mean, I mentioned this on a previous discussion. So we've got many more mega funds creating RIAs. And then now we're seeing, and this kind of relates to the venture studio model of people building, so Tribe Capital launched a roll-up strategy. So they're essentially, putting together roll-ups and they're, building alongside investing. So I feel that's going to be more and more prevalent, and there's just going to be a blurred line between late stage growth equity to buyout, and some of that's just going to flow into each other as a funnel. But yeah, on top of the RIA, I'm seeing, company incubation, company creation, and then having that flow into a strategic roll-up, right? So you've got the car wash, now you got software to take credit cards, software, on the website to do subscriptions, and then that integrates in with Turo, because Turo drivers also need to wash their cars, right? And then,
right.
So.
Well, the other interesting things happening now that's just from obviously the AI trend is real. It is, I think, as big as kind of just even the introduction of the internet in terms of everything it's opening up. Different ideas, different capabilities. And what I've heard is venture firms looking at their current portfolio and saying, if you started pre-AI and you're not a native AI, you may not get an exit. You may be a zero.
Sure.
Right? Because you're going to get leapfrogged by new companies that are native AI that are just going to run right past you. So that's a very interesting dilemma, for a lot of firms, for both companies and the funds.
Sure.
So yeah, a lot of changes happening. And you mentioned the studio and studio models, and our friend Sarah with Vault Fund. Sarah was my first hire at Cintrifuse. She's got a very interesting niche that she's focused on with the studios. And you typically associate studios with venture, and that's just, hey, we're building companies. We're incubating and building companies.
Yeah.
What I'm trying to do with Refinery is similar but different. I think it's more like the search fund, private equity search fund, but for early stage tech.
Sure.
So our searchers are either going to start a company or they're going to join an existing startup and will invest.
Sure. Yeah.
And I don't know that anybody's really doing that in that way, right?
I totally agree. There's a guy, he was on my podcast, John Stanberg. He's one of the only fund of funds that I know for search funds. So really interesting guy. I mean, he owned a vineyard for a long time. Yeah. And, has built a platform around just investing in search funds, essentially. And we've had a few search funds in our fund accelerator as well. So it's just a very unique model.
well. Search funds have done better than outperform venture.
Yeah, I totally
And it
agree.
makes sense. It makes sense because the investors put up a little bit of money,
Mm-hmm.
1% or less, to just fund the searcher while they look for a business to buy.
Mm-hmm. That's pretty much almost like a management fee, pretty much, right? I mean, the equivalent of whatever the management fee is. It's less actually because it's 1% where management fees too, right?
Right. It's less. And if the searcher comes up empty because they're a searcher, you're not out much money. You don't.
Sure.
You're not blowing it. And if they do get a deal on a term sheet, it's in the case of search funds, you at least have an asset of some sort, right?
Absolutely.
It's not just an idea. So everybody I know that's done the search fund model has done very well. So basically, I'm trying to do that model, but for early stage tech. Like the search funds are typically existing kind of non-innovation driven businesses.
Absolutely.
No offense to those who are, of course, because I'm sure there are some, but it's really, like I said, kind of a micro PE model.
Sure.
But we're applying it to venture. Because we think that there are, well, first of all, if you've ever run anything, you know that it's all about the people, right? It's all about
absolutely.
When you first get into venture capital, it's one of the first things I remember learning was ideas are a dime a dozen. It's execution that matters at the end of the day, right? If it's a good idea, there's a lot of people who have an idea. So there's no better place to invest your time and energy than into talented people, and that's the model that's the benefit of firms like Sequoia have over the years, is through their investments and successes over the years, they've got the best talent network, bar none, and at least out there. So I'm gonna build one that's is good, but it's not in Silicon Valley.
Absolutely. What would you look for when you're looking to hire talent? What are some of the
Good question.
hard skills, the soft skills as you're looking to expand your team? And just over the years, right, you've developed a lot of talent, growing Cintrifuse and trying to figure out what the DNA is for being a good asset manager as a whole. It doesn't have to be venture, it doesn't have to be search, but what are the traits of just a good asset manager, people that are deploying capital? You hit on one of them, which is just kind of having good values and doing right by people. But, maybe you can break it down, the hard skills and the soft skills.
Well, the way we look at it is, first of all, the first key is the growth piece. We look at people that have gone through the 1 to 10 million, 10 to 100, and really want to understand what role they played in that they contributed to it. They saw what it's like. It's like experiencing gravity or experiencing lack of gravity, right? Sure. I could train you to be an astronaut and you can understand it, but until you've experienced that, I have no idea how you're going to handle it, right? So that's a key criteria that it sounds logical, but people don't necessarily look for that. They sometimes get distracted by the exit, right? So you talk to somebody and maybe they had an exit and they sold the company, which is also very valuable, right?
Sure.
It's easy to start companies. It's hard to finish them, or exit. But you say, oh, great. Yeah, you sold for $50 million. How big was the company? Oh, well, we grew to 2 million or 3 million or something like that. Well,
sure.
That doesn't really qualify as the hypergrowth.
Absolutely.
You built something very interesting. I'm not saying you're a dummy by any stretch or that the next one can't be successful, but I'm a fan of a lot of stuff that Nassim Taleb has written, Anti-Fragile and Skin in the Game and those books. And one of the first books I read of his by accident was called Fooled by Randomness. He was like a New York quant.
Sure.
And Fooled by Randomness, one of the things he talks about is a lot of entrepreneurs that have successful exits, they had those successful exits because they're that good.
Sure.
And the truth is they might have just been lucky. Oftentimes it's just being lucky. And so I use the metaphor of a surfer in a wave. It's not like the jockey and the horse, it's a surfer in a wave. I could have the best surfer in the world. I could have the best, most aerodynamic, waxed surfboard and put you on that surfboard and standing in a puddle and it will do nothing, right?
Yeah.
or I could put you on a 2x4 in the middle of a big swell, and you're gonna do great. So
Sure.
the market timing and the market conditions have more to do with that success than anything else.
Mm-hmm.
And so you have to be careful to how you attribute that success. But back to the people we look for, we look for the growth piece. Then there are 4 things that I've kind of accumulated over the years that are, let's say, kind of proprietary, some less more than the others, but there are 4 of them. So the first one is EQ, right? Emotional intelligence.
Yep.
Do they have empathy for their customers and empathy for their employees?
Sure.
Right. That's a key that comes with comes from a lot of my customer-driven product design experience. If you're gonna unlock a new market opportunity and you intuitively sense it, it means because you're intuitively in to what people actually want and need.
Sure.
So that's the first one. The next one is, I call them the quotient. So it was EQ, then it's GQ, which is
not the magazine.
Not Joel. That's Mr. GQ.
I wish.
It's growth quotient. So it's your growth
Sure.
mindset. Are you a lifelong learner? Do you are you constantly trying to learn and challenge yourself?
So there's a book, I think I mentioned it over the dinner. I think it's The Magic of Thinking Big. And
Yes.
there's actually research around a sample set of people that had the same education, had the same skills, and just by default, the person that thought bigger did well. And then you and I went on this tangent because I think it's really interesting. We don't have to, specifically name people, but one thing that I remembered you sharing at that dinner was you did a personality test, and there's some people that are visionaries, and then there's people that are more tactical. And, it doesn't mean that anyone, whether you're visionary or tactical, that you would do better, but I think there's interesting outcomes that can come out of that and different.
Yeah, a lot of the people in our X15 network, these leaders, they're not necessarily all visionaries or want to be founders.
Sure.
They'd love to find one and partner with them and help them achieve their vision. There's a lot more of those, and that's fine. The third area, I'm thinking big, definitely came out in like 1959. It's awesome. But what he relates to in that, what he talks about in that book relates to this third area, which I call AQ, which is adversity quotient. For that one, I'd refer you to this book, Leadership in the Art of Struggle. And the great quote in here is, all leaders face adversity, exceptional leaders thrive in it. So, and this is what in Thinking Big he talks about, right? The people that end up having the most success are the people that when they face a struggle and they get knocked down, they go, what can I learn from that?
Sure.
What can I take? It's not just somebody else's fault. It's okay, well, it might have been mostly somebody else's fault, but I probably could have avoided that person, or, I could have learned something from that situation to protect myself or what have you.
Absolutely.
And that's the important thing. It kind of goes back to growth mindset and learning. But it's through struggle that our character is built and our reputation as a leader is built. And that's actually where the name for the fund comes from, Refinery Ventures. And from my own experience as a leader, some of the most painful experiences I had as a leader were also the most valuable.
Absolutely.
Right? I wouldn't replace them, but they sucked at the time. And so
pain is the best instructor.
I always say I got all the scar tissue on the back, right? Which causes me to avoid those things again.
Well, when you talk about refining, again, not to just quote another person's quote, but there was a story by Steve Jobs, I think it was in one of his interviews, and it talked about him going next door, and one of his neighbors had this, like, I guess it's like a rock smoother. I guess you throw a bunch of rocks in it and you spin it, and then over time, the rocks just become like pearls, And he was just saying that's kind of how Apple was, right? I mean, there's just a lot of bumps, but then over time, as you learn, as you make those tweaks, as you pivot, the rocks become very smooth, right? So when I think about Refinery, I think of just refining the process and just kind of improve, constantly iteratively improving.
That's right. I call that experimentation is like building a muscle in terms of corporate culture, is learning how to do that and do it as fast. So you're learning quickly. I took the word refinery came to me actually from a biblical reference, Isaiah 48:10, is, behold, I've refined you, but not as silver, but through the furnace of affliction.
Mm-hmm.
That's how we get disciplined. That's how we learn.
Sure.
Or learn.
Mm-hmm.
And then the last area that you don't hear much about is PQ, or paradoxical leadership.
Mm-hmm.
So particularly in a startup, managing paradoxes is like what you do all day long. I didn't know what that was called, but
Mm-hmm.
as a CEO, I called it healthy tension. Like when you're in a meeting in your room and do we go this way or that way? And everybody's arguing
Mm-hmm.
about it. I wanted everybody's best ideas. I didn't want anybody to be a wallflower. You had to speak up. And a lot of times there's a lot of unspoken assumptions. And when they come out, you learn stuff, right? It's kind of the iron sharpening iron. It's like, I believe this and you believe that.
Mm-hmm.
And like, how can we be that far off? And once you start clashing, you start to expose all those unspoken assumptions. And you go, oh, now I know why you don't like this. It's because you got burned on that in the past, or because it may cost you more margin than you thought, or whatever it might be.
Mm-hmm.
And it turns out, and there's an F. Scott Fitzgerald famous quote that says, a sign of a brilliant mind is somebody who could hold two opposing thoughts in their mind at the same time.
Mm-hmm.
There's actually, I found out by chance that the dean of the business school at University of Cincinnati, Mary Ann, has studied this for 25 years and co-authored a book called Both And. I don't have that book. I don't have it handy, but they studied this.
Yeah.
And where have you heard business books and business leadership talk about managing paradoxes?
Sure.
Here's a good startup paradox example. You have to go fast.
Mm-hmm.
But the only way to go fast is to fail.
Absolutely.
So it's not linear at all, right?
Sure.
It's like, I want you to do things that are wrong. I want you to come up with 999 ways that you can't make a light bulb, right? You can ultimately make the light bulb. That's a paradox.
Mm-hmm. So, Tim, final question for you. So you've been in Silicon Valley. You've, worked, at one of the most iconic companies of all time, of all humanity, Apple. Wish you had a couple Steve Jobs stories, but you've got so many other ones. You pretty much have been through the beginning of the internet. You've, successfully been a serial entrepreneur. You co-founded one of the incremental fund-to-fund strategies in Cincinnati. So all I have is just one more question for you. Give me one piece of advice from a mentor, a family member, or just a work experience that you want us to take away.
Good question. There's a bunch of things there. At the end of the day, as a leader, I always say my bookshelves when I was younger, all my bookshelves were filled with books about technology.
Mm-hmm.
Now they're all psychology, right?
Sure.
I value people. I view, everybody is created in the image of God.
Mm-hmm.
Everybody has value.
Sure.
They don't have to agree with me or even that if they don't want to. It doesn't matter. I'm going to treat them with the same respect when I'm firing them, when I'm coaching them. But I believe in people and the potential for people. And great leaders have shown that they believe in their people before their people believe in themselves.
Mm-hmm.
Right. So my suggestion is to look at people you work with, look at your partner, your customers through that lens, put yourself in their shoes, understand where they are, and be full of grace and seasoned with salt. Right. You don't have to hit people over the head with the truth. You can understand that we all come from different backgrounds, but at the end of the day, if we can't figure out how to work together and work effectively, then we've got nothing.
Sure. I totally agree. Relationships are everything. And I might have mentioned this. I mean, no matter who you meet or who you treat with respect, you never know if they could be your boss one day or if they know someone that is a decision maker. But I think you should just try to help people when you can without expecting anything. And the universe works itself out somehow.
Absolutely. Yeah. Who did the book? Adam Grant did a book. And he talks about Dave Hornick from August and just taking meetings with people and not expecting to get anything back from it.
Sure.
That made me feel so much better, because some people would say I was wasting my time. But to your point, it could come back years later.
Absolutely. Yeah. Say yes to everything. And so one of my recent podcasts, there was a saying, and I think I posted this as a quote, but Rob Balandian, who runs Cambridge Wilkinson, their pretty large investment bank, one of his quotes was say yes to everything. That means, maybe take every meeting, but if you've scaled your leadership, you could still take every meeting, but it could be one of your team members that's kind of representing you and representing the firm to be able to get the most coverage, right? To be able to get the most access to those relationships, because you can't take every meeting.
Some of the most successful people I know, and people in YPO, always find a way to make time.
Sure.
It's the person that never has time, that's just a little bit, too full of themselves.
Oh, yeah. I mean, I get jealous of, I have the few people that are mentoring. I mean, these people are in their 20s and they're not married. They don't have kids. They go to events 8 times a week. And I'm like, man, I can barely go. I went to your dinner. I kind of had to move things around, and I was really glad that I got to go to your dinner. But I can't go to every single one because I got, 2 kids and there's childcare responsibility. But if you're that one person that goes to every single event and meets every single person, there's a lot of people that can't do that. So that in itself gives you an edge. So, and I know you sure as hell can't go to every meeting either. So you try to scale yourself and replace yourself with other people to get that scale. So, well, anyways, Tim, I know you got to run, but thank you for the time. A lot of wisdom, and really enjoyed. Every time I meet you, I feel like I get excited to get to know you better. And thanks for sharing all of these learnings with the community. So really appreciate it.
Thanks for having me, Joel.
See you in July.
All right. Bye.
All right. Take care. Bye.